Analyzing and recording transactions, Chapter 2. Learning objectives. Explain the accounting cycle. 2. Describe an account, its use, and its relationship to the ledger. 3. Define debits and credits and explain their role in double entry accounting. 4. Describe a chart of accounts and its relationship to the ledger. 5. Analyze the impact of transactions on accounts, record transactions in a journal, and post entries to a ledger. 6. Prepare and explain the use of a trial balance. Vignette video. First freestyle skier to successfully defend an Olympic gold medal. Wignette became the first Canadian athlete in history to win a gold medal on home turf at the 2010 Vancouver Olympics. Alexander captured the imagination of an entire nation. In 2014, he took part in his final Olympic Games, where he successfully defended his title. He became the first Canadian double Olympic champion in moguls freestyle skiing. He learned determination and perseverance were the keys to success. In his new career, Alexander is a CPA with KPMG in Montreal. Other videos: the Debit Credit Theory rap song and the hand game. The accounting cycle. Chapter 1 and 2 is Analyze Transactions. Chapter 2 is Journalize, Post, and Prepare Unadjusted Trial Balance. Chapter 3 is Adjust and Prepare Adjusted Trial Balance. Chapters 1 through 4 is Prepare Statements. Chapter 4 is Close, and also Chapter 4 is Prepare a Post-Closing Trial Balance. The account is a detailed record of increases and decreases in a specific asset, liability, or equity item. Assets equals liabilities plus equity. Some examples of assets are cash, accounts receivable, supplies, furniture. Some examples of liabilities are accounts payable and notes payable. Some examples of equity is Haley Walker capital, Haley Walker withdrawals, service revenue, rental revenue, salaries expense, and advertising expense. The ledger is a record containing all accounts used by a business. It may be computerized or maintained manually. Each company has its own unique set of accounts. The T account represents an account in the ledger, used as a learning tool. The difference between the debit side and credit side is the balance. So you have an account title, you draw a T, the left side are debits, and the right side are credits. Calculating the account balance, Exhibit 2.5. This is the T account for cash, based off of the transactions from our company. Debits, $10,000, $2,200, $1,900. Total debits, $14,100. Credits, $2,500, $1,000, $700, $900, $600. Total credits, $5,700. Subtract credits from debits equals a debit balance of $8,400. Double entry accounting. Transactions are recording using debits and credits. Every transaction affects at least two accounts. Equal debits and credits will keep the accounting equation in balance and prevent errors. Debits always equals credits. Assets equals liabilities plus equity. Assets. When you increase an asset, it's called a debit. When you want to decrease the balance of an asset, it's called a credit. Liabilities. When you want to increase a liability balance, you credit it. When you want to decrease a liability account, you debit it. Equity. When you want to increase the balance of equity, you credit it. When you want to decrease the balance in equity, you debit it. Debits are always on the left and credits are always on the right. Debit and credit effects for accounts, Exhibit 2.8. Profit only adjusts owner's equity capital or only adjusts owner's capital after financial preparation to prepare owner's capital for the next period. So if we open up the equity accounts, we have owner's capital. If we want to increase that, we do a credit. If we want to decrease that, we do a debit. Owner's withdrawals. When we want to increase the amount, we debit it. And when we decrease the withdrawal, we credit it. Revenues usually are always credits. So when we want to increase a revenue account, we credit it. Sometimes we may decrease a revenue account through adjustments, we would debit it. Expenses, they're normally debits. So when we want to increase the balance in an expense account, we debit it. When we decrease the balance in an expense account, we credit it. Normal balances. An account's normal balance is the debit or credit side where increases are recorded. So for assets, the normal balance is a debit. For liabilities, the normal balance is a credit. And for equity, the normal balance is a credit. So when you add up all the balances in these accounts, your final balance should be as a debit for assets and as a credit for liabilities and equity. Remembering debits and credits, ALCREW. Step 1, write down the account types using ALCREW. So we're just using this acronym. So ALCREW, assets, liabilities, capital, revenue, expenses, withdrawals. Step 2, write down the normal balances, debits for assets, expenses, and withdrawals. The others are all credits. So assets, expenses, withdrawals are all debits, and the rest are credits. Those are the normal balances. Step 3, remember increases are the same as the normal balances. Decreases are the opposite. So when we fill this in, we have the normal balances. So to increase a normal balance, it's the same as the normal balance. So debits for assets, to increase it is debit, and to decrease it is the opposite. Liabilities, normal balance is a credit. So to increase it, it's a credit. To decrease it, it's a debit. For capital and revenue, the normal balance is a credit. So to increase it, it's a credit. To decrease it, it's a debit. For expenses and withdrawals, the normal balances are debits. So to increase those balance, you debit, and to decrease those balance, you credit. Summary, debit and credit normal accounting balances. Debit and credit summary. Debit record, assets, expenses and losses, and withdrawals. Debits decrease existing liabilities. Credits record, liabilities, revenues and profit, owner's capital. Credit decreases existing assets. Normal account balances. Debits, assets, expenses, withdrawals. Credits, liabilities, owner's capital, and revenue. An account's normal balance is the debit or credit side where increases are recorded. Chart of accounts. A list of all accounts used in the ledger by a company, unique for each company. Accounts are usually numbered. The chart of accounts shown in Appendix IV lists the accounts used in the book. 4 big picture steps of the accounting cycle. The first 4 steps of the accounting cycle are illustrated below. Step 1, analyze transactions based on source documents. Step 2, record a journal entry. Step 3, post the journal entry to a ledger account. Step 4, prepare a trial balance. Analyzing transactions. Steps: determine which accounts are being affected. 2, determine if account balances are increasing or decreasing. 3, apply rules of debits and credits. Entries are originally recorded in the general journal. This process is called journalizing. So for example, on March 1st, 2020, the owner made an investment of $10,000. So she put cash into the bank account and cash went up, debit. She also contributed that cash herself, so that investment went into capital and investment went up, credit. Cash is an asset, so when you increase an asset, it's a debit. Capital is an equity account, so to increase an equity account, it's a credit. On March 1st, she bought supplies at a store and paid cash. So supplies is an asset account. We increase it, it's a debit. Cash is an asset account. We decrease cash, so we credit that. On the 1st, she also bought additional supplies of $1,100. She bought equipment of $6,000, and she's paying $1,100 later, and she signed a note, a bank note, to pay the remainder later as well. So supplies and equipment are both assets. To increase those accounts, we debit them. Accounts payable and notes payable are both liabilities. To increase those accounts, we credit them. Posting journal entries. General journal information is transferred to the general ledger. Account balances are updated. This process is called posting. 6-step process for posting journal entries. 1. Identify the ledger account that was debited in the journal entry. 2. Enter the date of the journal entry in this ledger account. 3. Enter the source of the debit in the PR column, both the journal and page. 4. Enter the amount debited from the journal entry into the debit column of the ledger account. 5. Calculate and enter the account's new balance in the balance column. 6. Enter the ledger account number in the PR column of the journal entry. Repeat the 6 steps for credit amounts and credit columns. The posting process, 6 steps, Exhibit 2.13. So from the journal entry, our first journal entry was cash and Haley Walker Capital. So if we open up the ledger account for cash, we transfer the $10,000 for cash into the ledger account. So you'll see the $10,000 is a debit, and then the final balance in the cash account is $10,000. The next is Haley Walker Capital, so we open up a ledger account for that. And then we transfer the $10,000 credit to the Haley Walker Capital account, and the balance in that account at this point in time is $10,000. Accounting transactions in action. Example 1. The owner invests $10,000 cash in the business. Accounts affected: cash and capital. Cash is increased and capital is increased. When we increase cash, it's a debit, and when we increase capital, it's a credit. The T account shown here is just a version of the ledger account, just with less information. So when I post into the cash account, I take the $10,000 debit of $10,000, and when I post into the capital account, I take the credit of $10,000. Example 2. The company purchases supplies by paying $2,500 in cash. The accounts affected are supplies and cash. Supplies go up, cash goes down. Supplies, when you increase it, it's a debit because it's an asset account, and that's the normal balance. Cash, when you decrease it, when it's in asset account, you credit it. So now when we put these into the T accounts, Supplies, debit, $2,500. Cash, credit, $2,500. Example 3A. The company purchases supplies for $1,100 on credit. Accounts affected, supplies and accounts payable. Increase or decrease, supplies increase, accounts payable increase. Supplies is an asset account. When you increase an asset account, you debit it. Accounts payable is a liability account. When you increase a liability account, you credit it. And now the supplies go in at $1,100 and the accounts payable go in as $1,100. So you'll see there is already a balance in supplies account or a transaction from number 2, and that's okay. We just add up all the debits and the credits at the end, and then we put a final balance on that T account. Example 3B. The company purchases equipment for $6,000 on credit and signs a note. Accounts affected, equipment and notes payable. We increase equipment and we increase notes payable. When you increase an asset account, you debit it. When you increase a credit account, when you increase a liability account, you credit it. Now we see us posting this into the T accounts. Equipment, this is the first transaction, $6,000 debit. Notes payable, this is the first transaction, a $6,000 credit. Mini quiz. Indicate whether a debit or credit is needed to increase rent expense, debit. Increase accounts payable, credit. Increase revenues, credit. Increase cash, debit. Increase withdrawals, debit. Increase or decrease notes payable, debit. Decrease accounts receivable, credit. Trial balance. A list of accounts and their balances at a point in time. Used to determine if total debits equal total credits. Also used to prepare financial statements. Here is an example of the trial balance for Organico, March 31st, 2017. So we take all of the account balances from the T accounts and we transfer the balance to the trial balance. So cash debit 8070, accounts receivable debit 0, supplies debit 3600, prepaid insurance debit 2400, equipment debit 6000, accounts payable credit 200, unearned food service revenue credit 3000, notes payable credit 6000, Haley Walker capital credit 10000, Haley Walker withdrawals debit 600, food service revenue credit 3800, teaching revenue 300, credit, salaries expense debit 1400, rent expense debit 1000, communication expense debit 2300, underline total debits $2300 double underline, credit underline $23300 double underline, in balance. Review. Which accounts have a normal balance on the debit side? Which accounts have a normal balance on the credit side? What is journalizing? What is posting? What is the purpose of a trial balance? Summary, Chapter 2. 1. Explain the accounting cycle. 2. Describe an account, its use, and its relationship to the ledger. 3. Define debits and credits and explain their role in double entry. 4. Describe a chart of accounts and its relationship to the ledger. 5. Analyze the impact of transactions on accounts. Record transactions in a journal and post entries to a ledger. 6. Prepare and explain the use of a trial balance. End of Chapter 2. And that's the end of Chapter 2 lecture.